Okay, I think it is officially 2 o'clock. Hopefully we have most everybody on the call. Welcome so much and thank you for joining me today. I feel it feels a little weird to be just talking to my computer in an empty room, but please forgive me if I make some Zoominar faux pas or trip on the technology. These days, I still feel a bit of a novice in this area. I've taken over the guest room in my house in hopes of avoiding dogs and at-home college students and deliveries or anything that might interrupt. So hopefully it will be relatively quiet and I can get through the presentation and all of you will be able to get questions in. To that end, I am accustomed to, I guess, just making kind of housekeeping commentary at the start of a workshop. So I would say, even though we're Zooming, the same rule still applies. Please do what you got to do, because quite honestly, I'm not going to know any differently if you walk out of the room, you take a phone call, you pet your dog, any of the above. So feel free to make yourself comfortable and take care of whatever business you have at hand. I will be trying to monitor the chat box while I go through the presentation, in particular as I stop and move from one topic to the next. So if you do have questions, please feel free to type them in the chat and I will try to get to them as we go along. And I will also have time specifically at the end where I'll be able to try to field questions as much as possible. So with that, I think I'm going to proceed. So our agenda today is really focusing mostly on cash flow and budgeting and contingency planning and how do we try to adapt to this unpleasant new reality that we're all currently in. And then towards the end, I'm also going to cover an overview of the Family First Act and the CARES Act and provide some highlights specific to nonprofits in those areas. And then, as mentioned, there'll be some time for Q&A. Obviously, all of these topics are in many ways interrelated, so I've grouped them in what I think is a relatively logical flow, but they all overlap and there will be, some commonality from slide to slide. I really thought today the most helpful thing to do, or sort of approach to take, was to try to really provide a high-level overview of how you might approach these areas and some references where you can research more materials or templates or guidance that may then be more specific to your organization, and you can kind of take it from there at a more detailed level. So that is my plan today. In that vein, there are some great compilations of resources on a wide variety of topics already available in terms of COVID-19 response on the Community Foundation's website itself. On our landing page, when you go to the COVID-19 webpage, you'll see a long list of different types of resources and materials that are available. Silicon Couloir also has a great list of articles and templates that are fabulous guidance. Shout out to Gary Trauner if you are interested in hearing more on some of their topics. He is the presenter on this series tomorrow, and I know he will augment what I've said here and expand in areas that I'm not covering. And just thanks to Gary for pulling together some of the resources that he has pulled together. His are targeted primarily towards businesses and small businesses, but we all know that most nonprofits, and certainly most of us here, fall into that small business bucket. So it's a useful resource. Another one is the Nonprofit Finance Fund. I have found that area to be particularly helpful on addressing financial topics, and the two templates that I'm going to share with you today for projecting cash flows and for doing scenario planning both come from the Nonprofit Finance Fund. Silicon Couloir has one as well. I think sometimes what's helpful on the nonprofit finance templates is their language is a bit more specific to nonprofits Gary's is a great model, but you might have to, modify some of the language to terms that we sometimes throw around in the nonprofit sector a bit more frequently. The last is the National Council of Nonprofits. They have created some great summaries on the recent legislation. So an analysis of the CARES Act, a table showing all of the different loan options and the parameters that are available to nonprofits. And they have some wonderful materials and summaries that I have found were good to, for example, share with my board, because it was a one-page summary, high-level key points, and covered the primary topics of interest to those of us in the nonprofit sector. So that's a great resource for summaries, particularly to share out to other constituents in terms of explaining how we're affected. So in case all of you are feeling a little bit overwhelmed on where do you even start, because especially if finance is not what you live and breathe on a regular basis, it may feel overwhelming to suddenly have all of your assumptions perhaps dashed, or revenue cease to come in and expenses are all still there, and it may just feel challenging to even think about, where do I start? So the reassuring aspect of this question is there is some pretty common answers to that when you look at the resources. This page here, obviously you can see, is straight from Silicon Couloir's webpage. And step number 1, assess your current state, followed by cash flow is the #1 reason why businesses fail. This is a common sentiment. Step 1, assessment. This is from the Nonprofit Finance Fund's webpage. And you'll see here that they preface this by saying they started with 2 questions when confronted with, how do I even begin to tackle this challenge? Those were, what would be the most useful first step for the widest possible group of nonprofits? And what could every nonprofit do in a few hours? Again, similar to Silicon Couloir, understand your situation was the first step, and that was cash flow. So it seemed to me like that would be a really logical place to start for all of us, is how do we begin to contemplate and look at cash flow as we think about how do we respond in this crisis. So starting there. Cash flow projections and forecasting. There is, again, consensus on the most logical place to start when you begin to think about your cash flow is first looking at, what do you currently have? What do you have available in terms of cash resources? And that's not just what you have in your operating checking account, but thinking much more broadly about, what do you have in the way of unrestricted and restricted assets? What do you have in the way of operating reserves? Are there board designated quasi-endowments that could be used and or leveraged in some way at this time? Is there available credit? I know many of us operate debt-free, but some of the nonprofits here, I do know, work seasonally and have lines of credit that are regularly used, and looking at any lines of credit that are in place or could be obtained at this point in time for additional financing is an important piece in looking at the assets that are currently available as a starting point. Obviously, then the next 2 pieces of your equation are, how much do you regularly spend and how much can you raise during this period of time? In terms of modeling, as I mentioned previously, Silicon Couloir has some models on their website. They have a cash flow management guide and checklist, as well as a template spreadsheet. The Nonprofit Finance Fund also has a cash flow tool. I think what's important to emphasize here is that for many of us, we have a sense of how we spend our money and what our obligations are, but just kind of winging it based on what we think we spend, this is not the time to do that. You really want to take some time to work with your finance officer or your accountant or your bookkeeper to probably first do a look back on what have you actually been spending over the past year, to help inform your projections of what you are going to be spending and may need to spend in the next 3, 6, 12 months. In that vein, this is a picture of the nonprofit finance funds template, and keep your fingers crossed if technology works. We're going to actually take a look at it. Can everybody now see a spreadsheet instead of my slideshow? Hopefully, yes. Yes, yes. Okay, I'm getting some yeses in the chat box, so this is good. So what you can see on this is there is a, hang on, I gotta move my box so I can actually see what I'm looking at as well. You'll see here you've got beginning cash, and they've broken it out into unrestricted operating cash on hand. As you scroll through, you can see you have the ability to put in different types of income, whether that's earned or contributed. Perhaps there are cash that has been released from restriction, and then various types of operating costs. They have included also non-operating at the bottom, where you might pull in long-term contributions or debt financing or loan payments that are required to add into the modeling. But I think the key areas for most of us are really going to be focusing on what's coming in and what's going out on a regular basis. It has the ability here where they've got projections as well as actual, so that you can be planning and tracking how you're doing. Again, in terms of looking back for accuracy, you can pull in some actuals from prior months, maybe at least 3 to 6 months look back to sort of say, are there regular expenses that we are incurring that would be important to make sure I'm tracking accurately. Oh, hang on, now my technology isn't cooperating and I want to go back to my slideshow. All right, we'll have to do this the hard way. Give me a moment. Okay, sorry about that. Can everybody see the slideshow again? Great. All right, so next up, now that you've seen the spreadsheet, in terms of managing revenue and cash receipts, there are a number of things that I would encourage everybody to look at in terms of revenue and cash receipts. First, I would look at, is there a way to accelerate collection of anything that might be out there? Whether that's pledges, if you have receivables, look at receivables, but for many of us, it may simply be gift pledges. Can those be accelerated so that you're receiving them now in terms of later? Are there purchases that can be converted to donations? I think Kari mentioned this a little bit yesterday in terms of talking about events and event cancellations and alternatives to events. If you have had to cancel an event, or you've had something for which you had received ticket proceeds or receipts, rather than just automatically refunding, is there an opportunity to ask those to be made donations instead? I think a key one here is there an opportunity to convert restricted resources to unrestricted? It's always worth reaching out to your major donors, which is obviously the next point there. Stay close with major funders. Certainly within the funder realm right now, there is a strong push to be making gifts that are as unrestricted as possible, and to be redirecting gifts that may have been restricted to allow for unrestricted uses. So for many funders, certainly within the foundation realm, they are taking pledges, essentially saying, this is what we're going to do. We are going to make using any cash we've already granted recently as flexible as possible. We're going to postpone reporting requirements, and any new grants we make are going to be as unrestricted as possible to allow for maximum flexibility. So if that helps, if you have significant restricted assets that you have previously received in the form of gifts or grants, I would encourage you to reach out to those funders and see whether those constraints can be modified to allow you to use those funds today. It's also really important to involve your board in this thinking for two reasons. One is they can help in those conversations with the major donors and help be that ambassador that you want your board to be when you're in challenging times. But your board should also be coming to the table and stepping up in the same way that if you're asking for funding at any point in time in your life cycle, you want to be able to say, my board is participating in this 100%. So if it's COVID response, you still want to be able to say, my board is participating in this 100%. They've all given unrestricted giving to this COVID response, and that's part of your pitch to your major funders and donors, and making your case for why maybe their restricted gifts should now be made unrestricted, or why investing in you with unrestricted resources at this time is valuable and appropriate. The last piece, obviously, is to look at financing options and any federal assistance. I'm not going to jump into this in too much detail here right now, because that's going to be what I cover when we hit the CARES Act. But there are options there, and we should all be looking at them. If you haven't already, you should be taking a look at them now, and we'll cover that again towards the end. All right, I'm just looking at chat to see if there are any questions on revenues. Okay. All right. Managing expenses and payments. One thing that is helpful to consider when you're looking at your expenses and your payments are segregating those which are fixed costs. For example, your rent, mortgage, anything that is exactly the same from month to month. It doesn't vary based on whether or not you are actually delivering programs or not at this time, versus your variable costs. Personnel, arguably at the end of the day, is a variable cost, but I think we like to think of personnel as more fixed because we don't want to be scaling our personnel up and down based on our programs. But in extreme scenarios, our personnel are variable costs. The rent is generally fixed. So understanding which you can modify more easily versus others. The reality we're in is identifying what can be eliminated or deferred. This is a time when I think all of us are really going to be in the unfortunate position of hunkering down and scaling back, rather than refining and growing and augmenting our programs and our impact. I think where we can identify something that we still truly want to do but can be deferred versus what is simply just eliminated because it was an effort that was premised on growth assumptions and a robust economy and adequate staff, are things that at this point in time may have to be eliminated because the circumstances in which we are all operating have completely changed. Certainly, I would say negotiating with lessors, vendors, and banks at this point in time is worthwhile. Many landlords may be receiving relief from their own lenders and may have some flexibility to offer in terms of rent. Can it be waived? Can it be deferred? Can some of it be deferred? I think certainly while no lessor likes to say we don't need the rent, at the end of the day, a tenant who remains sustainable and pays some rent on a long-term basis or for a short period is likely preferable to a completely vacant space if it helps your organization remain afloat. There are no clear-cut right or wrong answers there, obviously, but I think the ask is what is important, and seeing if they can work with you to strategize on managing or deferring payments. I would say the same with vendors and banks. If you have major vendors that have any flexibility on payment terms or payment timing that are major expenses for you, this is the time to be talking to them. Likewise with the banks. And the banks are receiving some flexibility in this regard from, from the federal government. They're still going to have their own constraints, but treating them as partners in helping you problem solve will be worthwhile. I don't think we could have a conversation in this arena without talking about the potential need to reduce staff and/or compensation. none of us like to go here, but I think in this environment, when it is crisis management mode, we really have to address how do we look at staffing and our compensation. I think a couple of principles or guidelines I would say in this area is identifying the core and your core mission and those staff that are absolutely essential to try to retain on a long-term basis is important for your board and for senior management to think through. The other piece is there a way to involve your staff in conversations to provide for more buy-in and understanding on why decisions are made? And where I'm going with that is obviously not all staff can be involved in all staffing or compensation decisions, but soliciting feedback from staff in terms of we're looking for ways to cut our expenses by 20%, by 50%. Would love to hear your thoughts and ideas. If we have to make hard choices, would you know, what would be more appealing to you as staff members? A 20% pay cut or every Friday off unpaid? Could we cut voluntary benefits to at least show in good faith and open inquiry into where your staff lands on how they might possibly be part of solving that solution as a team versus simply saying we're going to cut a head count or this person's out or everybody gets this solution by default. Again, absolutely no easy answers when it comes to adjusting staffing or compensation. So I would just say being as creative as you can possibly be and thinking about what that might look like and involving the team as much as you can in an appropriate manner is worthwhile. I would also say this is a perfect time to try to reach out and collaborate with other nonprofits. Are there ways to do things together that reduce costs or help to retain staff? If there's somebody, you know, if you have a couple of organizations who are all looking at eliminating a part-time person, can people use that person collectively together in a collaborative way? Obviously no specific solution here, but just part of that tool list of, are there creative ways to think about retaining key staff in the nonprofit sector? And or from a collaborative standpoint, can we share resources in a way we didn't used to have to, so that they're all still there and surviving and we're keeping people engaged, even if in a slightly different way than we did before this crisis hit us. So I've already touched on the solicit staff input and the understand available COVID relief. Again, just delving a little bit further into the staff and compensation issue. I'm somewhat reiterating what I said in the last slide. I think specifically identifying and protecting the key staff that are essential to your long-term management and operating. Looking at your core programs, what you are currently needing to do and aligning staff with the operating needs and cash flow that you have today. Looking at pay cuts and reduced hours, perhaps instead of a full layoff, keeping people, but just in a slightly less costly engagement. I think many of us will ultimately have to consider layoffs in some form. And if that is the case, what is really important is to also anticipate what the impact of that layoff will be on everyone else in the organization. What are the essential job functions that must be maintained? Who picks up any job function that was previously done by that person? Who assumes those responsibilities, or have they completely gone because it's not something that's currently being done? Obviously, none of us like to consider laying off staff, so I think doing it in a manner where you understand the dynamics and you're sharing resources with affected staff members in terms of, for example, in the CARES Act, the expanded unemployment insurance options that are available. If we have to lay somebody off, to be able to say, here are some other financial resources that you will be able to take advantage of through augmented unemployment. There are the resources at 122, anything of that nature where you can help a staff member who is negatively impacted by changes you may have to make manage that change, because none of us want to be in that position, either on the organizational end making the layoff or on the employee end being laid off. Any questions on expenses? Okay. All right, I'll keep moving along. Continuity and contingency planning. In this scenario, like once you've developed a good cash flow model, the next logical extension of that is thinking through options and realistic scenarios, in which case you need to be probably looking at least two, and best case and a worst case scenario. So if everything goes as I hope it might, and all of my major donors commit, and I get lending, and I get a grant, here's what my operations will look like, to the worst case where none of that happens, and understanding what the implications are of the path you're going to have to take depending on how those assumptions play out. And again, that goes back to understanding if you have to cut staff, or if you have to cut programs, or if you have to cut expenses after you've made the asks for revenue, where does that lead if you start going down a particular path? So you're as prepared as possible in anticipating and being able to thoughtfully consider now how you take those actions, rather than having to make it more quickly under the gun in crisis mode. Again, this is one where when you have what those two scenarios look like, you ideally want to be clearly communicating with your partners. So specifically, if you are working with a bank or you're working with a major funder, to be able to articulate to them that you're doing this homework. You know, we have done our cash flow projections, and we've done some contingency planning around, you know, worst case scenario, if these events don't occur, this is what it looks like for our organization. And if it goes better, here's where we're going to make adjustments. Let's see, I do have a question. So question is, would you consider doing 3 models, worst case, best case, and reduced capacity? I don't think there's a right or wrong. I would say at least 2 is appropriate to consider, sort of the hardest decisions you're going to have to make, as well as if you're able to squeak by. Certainly, if you have staff and resources and sort of financial sophistication at the board or the planning level to be able to do sort of a middle of the road, maybe it's most likely scenario, that's absolutely worthwhile. I think, you know, beyond sort of most likely, best and worst, probably doesn't add a lot of value in terms of understanding the implications, because you're already getting a pretty good handle on what the spectrum of options looks like, depending on how the cash receipts come in. You do want to be clearly communicating with partners. I think Kari mentioned it yesterday in terms of her messaging around keeping in touch with your donors and your key donors. If they understand what the implications are if they don't make a gift, or they don't support you in trying to pursue that best case scenario, and you can clearly articulate what the ramifications are in terms of reduced programming, reduced impact, reduced constituents served, it's very compelling. And this is a time when we are in a very unusual circumstance where funders, to the extent they are able, are really invested in trying to ensure that our organizations have the ability to respond if they are on the front lines and serving at-risk communities, and or are ensured of their ability to survive, to sustain the vibrancy in our community that we have become accustomed to if they are out of operation right now. So I think both of those are very compelling pitches to donors and to lenders and to folks providing financing. And if you have done the contingency planning, you're better able to articulate what those scenarios look like and what the difference is in terms of community impact, or your ability to rebound at the end of this is. it also demonstrates good financial stewardship, which, wearing the Community Foundation funder hat, all of your funders want to know and have confidence that you are good stewards of their resources once they make that gift or that grant, and being able to talk about how you're planning and addressing the challenges that this crisis is confronting the organization with is a really tangible indicator of effective management, good stewardship, and good planning. So it makes a strong case for you. Again, ideally your board is supporting you in this and involved in, where appropriate, in making those asks or making those cases or thinking through those hard decisions that may need to be made, because those may have very long-term significant impact to what the future of the organization looks like. So making sure that your board is prepared and on board and supportive is definitely important. Okay, so here is a sample of the scenario planning template that comes from the Nonprofit Finance Fund. I think since I got stuck a little bit on the last time I switched over to the spreadsheet, I'll just talk about this one on the screen. What you'll see here is they do have the columns for budget to actuals as of a date, and then they have sort of an ability to adjust the assumption going forward. And the essential parts that you'll see here are budget assumption A, scenario A is best case, and B is worst case. So they are looking at, if we change these assumptions from program fees, from income, from contributions, if these come in different ways, how do we have to adjust? And then you'll see they also have a column for priority to-dos or just sort of notes. And I think this is just a helpful format, because you can see just below the revenue lines, you have the ability to tweak assumptions, whether that's salary and benefits or consultants or contractors or occupancy. And we won't go over there now, but the budget template in the Nonprofit Finance Fund goes through a number of different expense categories that can be adjusted. And obviously you would tailor these to whatever the expenses are for your organization and how you would adjust. And just thinking that through will provoke some really hard conversations on, if you say we get none of these contributions, how much do we have to cut in the way of expense to survive? Or if we get all of it, how can we adjust? Okay, I'll just pause very briefly to see if there are any questions on scenario planning before I jump into some of the legislation that has recently been passed. Okay. Again, there will be, like, if you're formulating your questions now and you're still digesting, there will be plenty of opportunity at the end of this. I did not prepare 2 hours worth of material, so I'm counting on you all to come up with some questions at the end to help fill our time. Or, you know, if we finish early, we'll all have a moment to go out and enjoy some sunshine and maintain our mental health. Families First Act highlights. So this was the first, or one of the first pieces of legislation that was enacted. And it really focused on relief for employees who were being directly affected by coronavirus. And what it did was expand emergency paid sick leave and emergency family and medical leave for most employers are subject to these regulations. So it's applicable to most employers with less than 500 employees. That's probably all of us on this call. It is effective from August 1st through December 31st. There is a very limited exemption on just the family leave piece of this for leave directly related to lack of childcare for employers with less than 50 employees, if it would, quote unquote, jeopardize the viability of the business as a going concern. Guidance from the Department of Labor is pending on exactly what that means or how you take that exemption, but that has been written into the act. So like many of the things going on right now, those of us who are subject to these regulations, whether it's the banks trying to do loans or employers trying to figure out how we provide this leave or whether we can claim an exemption, are still waiting for a little bit more clear-cut guidance, but that is there. The way they've structured it is that if you do have to pay for some of these mandated leaves, we should be able to claim an offsetting payroll tax credit. So I did include in the workshop handouts a good summary on this that outlines what the various leaves are that are mandated. I would clarify that these leaves, the sick leave and the expanded family and medical leave, are on top of any leave your organization may currently offer. It is not in lieu of. What I have asked the Community Foundation staff to begin to do, because I'm still not sure exactly whether or not we'll be able to claim exemption or whether or not, how exactly how reporting will be necessitated for claiming payroll tax credits. I have just asked my staff to begin to track when they are unable to work due to the school being closed or childcare facilities being closed. Thankfully, none of them are currently on leave because they're sick with coronavirus or caring for family members with coronavirus. We are just dealing with employees who can't work because of lack of childcare, but I'm asking them to track those hours so that when there is a little bit more clarity around how this is implemented from an employer standpoint, we at least have some of that data a little more readily available. The CARES Act was the legislation that was most recently passed, and it has gotten, I think, in some ways more attention, and I certainly have received more questions on the CARES Act than on the Families First Act that addressed employee leave. The CARES Act covered a wide variety of things, but one of the biggies was the emergency SBA 7A loans that may be forgiven under certain circumstances, also known as the Payroll Protection Program, or PPP loans. These were explicitly made available to 501c3s. So all of us have, I think, been furiously trying to look at the eligibility requirements and how they function and what the opportunity is for us. And we've all overwhelmed our local banks with loan information requests, loan applications, and they themselves are struggling to figure out how to actually get these into the SBA system and approved and what docs are needed, et cetera, et cetera. But that has been the biggest area of interest, and I will go a bit more into details on that. Another piece that was in this legislation was that what are known as economic injury disaster loans, or EIDL loans and grants, were also made available with fewer constraints, sort of fewer eligibility hurdles. This can be appealing in that while they are not forgiven, the grant piece, there's an emergency grant piece of up to $10,000 that can be requested for payment in 3 days. And that does not have to be returned whether or not you are ultimately approved for the EIDL loan. The EIDL loan is a loan. It won't be forgiven, in contrast to the Paycheck Protection Program. But it may be a worthwhile option because they are relatively affordable rates, and maybe in some circumstances a better fit, or if for whatever reason you can't get a PPP loan, there are some other options available. It also included an employee retention payroll tax credit, so that if you have a business that has been impacted by COVID and you continue to retain and pay your employees, there is the opportunity for a tax credit to be claimed through payroll taxes. There is also the opportunity to defer payroll tax payments. So if, when you're looking in those cash flow models, paying compensation and the related taxes is, being able to defer the related taxes would provide relief. That's definitely something to look at. From an employee standpoint, I think it's important to know that the expanded employment insurance coverage. Gary Trauner did some great work on looking at truly, doing some modeling. How much is that worth? And it is worth significantly more than just the one-time payment that will be made to individuals. It's a very valuable expansion of employment insurance credits and coverage. And so I think it's just, particularly if you have to look at layoffs or head count reduction, to just know that that's available. There were also some incentives for charitable giving, which I will touch upon, but hang on, there's a question. So let me just read this question real quick. So the question is, I thought the SBA would provide a $10,000 advance that would not have to be repaid. If our PPP amount would be $10,000 or less, would it make more sense to do the SBA loan? So the $10,000 advance, what I would say maybe one benefit to requesting an emergency advance through the EIDL grant, the $10,000, that essentially is just an emergency grant. Right now, those applications are online and are going directly to the SBA. So you're not going to have to work through a bank. So if your PPP loan would be $10,000 or less, it might be faster and more efficient just to ask for the $10,000 emergency grant. If you ask for the $10,000 emergency grant now, and you get a PPP loan that is ultimately forgiven, your PPP loan forgiveness will be reduced by the $10,000 emergency grant you received. I think I would also add, when you're looking at all the potential like tax credits or tax payment deferral, the legislation does indicate that if you get a PPP loan, that you're not eligible for the payroll tax credits or the payment deferral. So if you don't get the PPP loan, I would definitely be looking at the payroll tax credits and payroll tax payment deferral if the PPP loan is not an option, because you can't use those hand in hand. Hang on, there is one more question that I will look at here too. So I think this is a perfect segue. The question was, do you know what information that they ask you for in the EIDL application? Being an online application, it makes it hard to ensure that you have all the information ready when applying. I have walked through the PPP loan application. I have not walked through the EIDL SBA online application, but I would refer you to, this is one page of the handout that was in actually the materials that Annie forwarded to you. This is from the National Council of Nonprofits, and it spells out the primary differences between who's eligible for which loans and sort of what the requirements are. Again, I would draw your attention to, you can see here, it says the EIDL advance of $10,000 to be paid within 3 days. The processor is the Small Business Administration itself versus a local financial institution. There's no collateral or personal guarantees required. What they have said is that if you are looking at both an EIDL and a PPP loan, they cannot be for the same purpose. You could apply for them for different purposes. So depending on the expense structure of your organization, one could be used for compensation costs and the other could be used for other operating expenses. And those would be different uses. But you do have to make sure that you're not saying you're using these loan funds for the same thing, because that will disqualify you for one or the other. Oh, hang on, there are a few more here. Let me just scroll through these questions while we're on this slide. And just as one last follow-up on the what will be asked for on the EIDL application. Again, while I haven't gone through it myself, I would look at this table here in the materials that Annie sent out. There is also a U.S. Chamber of Commerce guide to EIDL loans that I would read through. I have found that the U.S. Chamber of Commerce guides to both the PPP and the EIDL loans were by far and away, in my mind, the most user-friendly, common language, clear-cut, digest, information regarding eligibility, eligible uses, forgiveness, requirements, and I would encourage you to look at those handouts in the materials. Let me see. Give me a moment while I read some more questions and see if this is a logical place to answer them. So one question is, we have an operating reserve and unrestricted funding that can cover our operating expenses through June. We're dependent on the tin cup or old bills for our operating costs, and board is questioning my decision not to apply for emergency funds because they say we are going to need them. This is a really difficult question, and I've received a question or two from our own board on this as well. With the PPP loans, there clearly is an intent that these are designed to address operating needs that are driven by economic uncertainty surrounding the COVID-19 crisis. Clearly, some of our organizations and small businesses are in crisis mode right now. But depending on a nonprofit's business cycle, we may be okay for the moment, but be in crisis mode 6 months from now when these loans are no longer available. So I think in some way, personally, I'm just speaking my own personal opinion, I think that if there is uncertainty looking at your year or your fiscal year overall and your ability to survive without additional financial support, I think it's appropriate to apply now because these loans are intended to cover a period of the coming year. And the reality is they're limited. And if we don't apply now and we hit November and December and we're out of luck, it will be far more challenging to identify alternative resources. So yes, I think if your board believes that your reserves are adequate to, I would say perhaps sustain you not just 6 months, but really looking out over the next year, because I think it's going to take our economy a while to truly recover from this, whether that be the stock market crash or the fact we've shut down our entire economy. My bias is towards thinking more broadly about it and looking at economic uncertainty and the need for cash, not just this month, but over the next, at a minimum 6, if not 12 months. Again, there's no right or wrong answer because I have spoken with some board members in other organizations who have decided that they do feel adequately prepared to survive without tapping into this resource, and that it is ethically more appropriate to ensure that the groups that need it most have access. Trump has begun to talk about trying to augment the amount of money available through this program. So we'll see whether additional funding becomes available or not. But I think in terms of thinking through whether it's appropriate to apply, I would just encourage looking at not just today or 3 months out, but look at where your organization may be on a slightly longer term basis over the period these loans are intended to cover. So can a PPP loan and Families First coverage overlap? Can a staff person be paid from PPP for part-time and claim a tax credit for the child care part-time taking? So my understanding of the Families First coverage is that any actual costs incurred that are covered under that act, so it has to be above and beyond what your organization already offers, which has to be used first, can still be paid through a payroll tax credit because you're incurring additional costs that the government has said they want to offset so that in providing for employees, they're not burdening employers. The PPP loan is intended for you to maintain current expense and employment structures. So in theory, if you are maintaining your current operating structure and you're having to pay additional employee benefits under Families First, I believe taking both of those is appropriate. What you can't take advantage of is the retention credit or the payroll tax deferral if you take the PPP loan. Next question. It seems many institutions are no longer taking applications for the PPP. Other banking institutions have put limits on who can apply. Yes, I have heard from a number of sources that because the rollout of the PPP loans has been so problematic and there is so much demand and so much difficulty currently in obtaining guidance from the SBA and in actually getting applications submitted by the bank to the SBA for approval, that I think just from a organizational management standpoint, many of the banks have said, we are completely overwhelmed and we have to put some constraints and parameters on whose loans we can accept and process. And that is indeed what we are seeing. And or they're saying, we'll accept your application, but we're going to prioritize our current customers or customers who have been with us since a certain date. As I understand it, Wells was sort of doubly hit because they also have some sanctions from their prior business scandals and the actions that were taken as a result of their prior practices that are also constraining their ability to process as much in the way of loans. So I did send out an email last week that highlighted all the lenders I was aware of locally who were processing or who were accepting loans, but I do understand that that landscape is changing. So if you're not already working with a lender, I would encourage you to, first talk to whoever your current bank is and whether they're participating. And if not, then just reach out to others and see who may still be accepting and what, who can offer you the best priority in line in terms of those loans. Okay. Yeah. And yes, I think there's just a comment here that someone has been waiting to apply for a PPP through their bank and that they have not received that invite yet. A lot of the banks are struggling with their own online application systems and or getting the applications they have received through the SBA system, which I understand crashed over the weekend due to oversubscription. So yeah, I think the banks are doing their best to process as many as possible under less than ideal circumstances, and being a squeaky wheel, and in that same vein, being patient is probably our best strategy in continuing to try to obtain guidance on PPP loans. All right, so I'm going to get into a little bit more detail on that. There are clearly lots of questions on it. Again, there's a great resource in your handouts that Annie forwarded on the Paycheck Protection Program, the PPP loans, but this is a highlight. The maximum loan amount that you can take out is 2.5 times your monthly payroll. Payroll is actually defined fairly broadly to include gross compensation, group healthcare benefits, retirement benefits, and state taxes. It excludes any annualized compensation over $100,000. It excludes federal payroll taxes and any employees you might have who are living abroad, if you have any employees in your organization currently who are living abroad. In terms of eligible uses for your loan proceeds, it can be used in payroll, again, as broadly defined. Benefits, it can be used for rent, it can be used for mortgage interest, but not mortgage principal, and utilities. And having listened to a couple of CPA webinars on this, my understanding is that folks are interpreting rent to be broad, so not just real property rent, but if you rent your copier or your postage machine, anything that is leased, whether it is your physical facility or equipment, would qualify for that payment. Let's see. Oh, 4 new messages. I have received a helpful pointer. Please don't all leave the seminar and call immediately, but I have a helpful pointer that Bank of Jackson Hole is allowing organizations that are not currently banking with them to apply for the PPP as long as you open a business checking account with them, and that most of the other local banks are requiring you to be a current business banking customer. So you heard it here first on the Community Foundation Zoominar. Please don't all overwhelm Bank of Jackson Hole, but they would love to talk to you about opening a business checking account and processing your PPP loan. Okay, PPP loan forgiveness. PPP loan forgiveness is equal to the amount spent on eligible uses during the 8-week period following your loan origination. I emphasize 8-week period here because there may be a mismatch between what you are eligible for, which is 2.5 times monthly compensation, versus how you can use it over the next 8 weeks. So in considering how much of a loan you might want to ask for, if you are assuming that it will be 100% forgiven, I would make sure that you actually have uses that will total the amount you expect to have forgiven if you have to only use an 8-week period and not a 2.5-month period. Forgiven non-payroll costs are capped at 25% of the loan amount, and it is ratably reduced if your FTEs or your full-time equivalents of employees or your wages are reduced. Again, this piece in bold that I have here is nonprofits facing uncertainty are encouraged to apply as soon as possible. This does go back to that philosophical question of how much uncertainty you're facing over what period of time, but I would suggest if you are facing uncertainty within the next 6 to even 12 months, I would definitely be looking at a PPP loan, or at a minimum, some of the other options that are available, whether that's deferral of the taxes or the employee retention credits, and sort of see what might be the best fit for your organization. Let's see. And Rocky Mountain Bank will do the same as Bank of Jackson Hole. So everybody now has 2 options to talk to if their current bank is not prepared to work with them. Okay. Briefly on the economic injury disaster loans and grants, you can apply for up to $2 million in working capital. There is the $10,000 emergency advance within 3 days, and that does not have to be repaid whether or not you get the working capital loan in the EIDL application. Again, the PPP and the EIDL loans cannot be used for the same purpose. And the PPP loan forgiveness will be reduced by the $10,000 emergency grant if you receive loan forgiveness and an advance. They will reduce the forgiveness by that amount. Let's see, another question. We are a seasonal business that had to lay off employees earlier than the end of the season. We applied for PPP to pay the remaining of the season. Does that affect their claims for unemployment? I don't believe that outstanding unemployment claims are affected currently. What the PPP loan will look at is whether you have rehired them within the time frame that is required for those loans. But you didn't, so I think when you're looking at your payroll, it's going to be for the loan amount, it's actually going to be looking back at what you paid in 2019, not what you paid in the most recent period where you may have already laid them off. And then let's say I have a question. To clarify, EIDL cannot be used for fixed expenses like payroll. EIDL can be used for any operating expense. It just cannot be used for the same thing as a PPP loan. So both of the PPP loans and the EIDL loans are very well, the EIDL loan is actually even broader. The EIDL loan is working capital for any use at all. The PPP loan is limited to those prescribed areas of payroll and rent and mortgage interest and utilities and benefits. But the EIDL loan can be used broadly for any operating expense. You just can't use both loans for the same thing. Okay, charitable giving incentives. So the CARES Act provided some nice incentives for folks. The first one is a $300 above the line deduction available to all individual taxpayers for 2020. By making it quote unquote above the line, it means that all individuals can take advantage of that deduction whether or not they are itemizing. So they can still benefit from that even if they are using a standard deduction. They also adjusted the gross income, AGI, adjusted gross income cap. Previously, charitable deductions were capped at 60% of your adjusted gross income. That has been increased to 100%. So if you are an individual who is in a position, who's lucky enough to be able to make charitable contributions that equal 100% of their adjusted gross income, they will be able to completely take that deduction. The limitation on that is that the gifts must be cash gifts to public charities only. Gifts to private foundations, supporting organizations, and donor-advised funds do not qualify for that. For corporations, the deduction limit for charitable deductions was increased from 10 to 25% of income, and food inventory was increased from 15 to 25% of income. So there are some nice giving incentives available for both all individuals at a very grassroots level of the $300 above the line, as well as potentially for major donors by that significant increase in the AGI cap. Hang on. Okay, so let's see. I have a question on how is the PPP forgiveness reduced if one employee is not maintained? Is forgiveness sacrificed completely or just reduced by a percentage? It is reduced by a percentage. So it will look at the percentage of your total employees that the loan was based upon versus the total number retained and or the total compensation. So it is a percentage. It is not an all or nothing. There are some formulas built in there that look at what you were able to maintain over the loan forgiveness period as a percentage of what you were previously doing. And let's see, on the charitable giving incentives, it says, are there any other type of giving channels like donor advised funds that are not affected by the stock market? I would say that almost all giving channels, even donor advised funds, are affected by a significant decline in the stock market, either directly or indirectly. Many donor advised funds are invested and take that hit just like any other investment pool. Not all are, but many are. And even with donor advised funds, those are like charitable checking accounts. So if an individual feels as though their personal net worth has suddenly been decimated by 20, 30, 40%, they're going to be less inclined to perhaps be replenishing their donor advised fund because they have other uses for it, and or they previously gave appreciated stock that had significant tax benefits, and those same tax benefits are not as material. So I think the challenge with stock market volatility and the drop in an economic recession is that it arguably will lead to depressing, potentially depressing giving levels broadly, simply because of the recession and the impact on the perceived or actual net worth of donors. Okay. Last quick item that I'll formally cover on our slides is the Community Foundation's own emergency response fund. Obviously, Shelby in particular has been fielding a number of questions and requests from folks in this area, and sort of how it's currently operating and how we anticipate distributing funds from it. Because of the nature of this crisis, we currently are envisioning that this response fund will be making grants in phases. And our current focus right now is on frontline healthcare organizations like the hospital, public health being the major players there, as well as nonprofits serving at-risk populations, low-income families without access to food, our seniors, folks who are struggling with mental health and well-being. So we're really focusing on, right now, ensuring that we are supporting 122 in its efforts to alleviate the financial impact of all of the lost wages, as well as public health and the hospital in managing the disease in our community and its impact, and then ensuring that everybody has food and shelter, and with our schools, equitable online access to learning from home. So that has been our current area of focus. We do anticipate that we will need to be looking at operating support for nonprofits to ensure that we are able to sustain our nonprofit community on a long-term basis and have the same vibrancy and diversity and breadth of community programs that we do today when we come out on the other end of this. That said, because we ourselves have limited funds and we want to first and foremost ensure that everybody in our community survives this crisis, we are expecting any nonprofits who ultimately come and ask us for additional, more operating support for sustainability have really done the heavy lifting as much as they possibly can before they come to the Community Foundation for support. And by that, we're going to be asking them about what measures and steps have you already taken to reduce your expenses, to access other forms of funding? Is your board all participating? Have you talked to major donors? Have you looked at utilizing your operating reserves? Because if we're not looking and using our operating reserves in a global pandemic, I'm not sure what we're saving them for. So, we're going to be asking some hard questions. Do you have unrestricted endowments that can or should be used? Because unfortunately, we don't have the resources to be able to say we can support everybody status quo through the course of this crisis. That said, we want to ensure as much as we possibly can that organizations don't close their doors during the course of this. We can't say that it's not going to be a painful process. So we are looking at requests being accepted online. We're trying to address them and determine any funding awards as quickly as possible with a task force that's comprised with our board chair and our grants committee chair and our opportunities fund chair. Know it's there if you are a nonprofit looking at operating needs, but understand we're hoping that you will have done all of the homework that I've been talking about for the past hour plus before you're coming to us as more a funder of last resort, and or as a partner in that, here's how I'm thinking about my contingency planning and my financing. And, if we really wind up in worst case scenario, here's where I'm going to be in 3 months, at least keeping us aware so that we might anticipate if that really comes down the pike, how we might be able to help, or if we can provide a small amount for a small period to get you to the point where you get SBA funding or something else falls into place. We're obviously hoping to maximize as much as possible what we're able to do with the limited dollars that are there. We will continue to fundraise for it as well, because I think our community's needs are great, and we are blessed to be in a community that is very giving, whether it's us or 122 or the hospital's funds. But it should be for the nonprofits, at least currently, while we're still in this immediate healthcare crisis management mode. That is where we are focusing our attention. Okay, and that is my last formal slide. So there are a number of questions that have rolled in while I've been going over that. So let me look through those. Okay, so one is clarify the conditions for forgiveness of the PPP loan. This is the part I'm not clear on. Forgiven at an amount that is equal to amount spent on eligible uses during the 8-week period following loan origination. Okay, so I would encourage you to, in your handouts, and I'm going to find the flyer myself. In your handouts, there is a U.S. Chamber of Commerce Emergency Loan Small Business Guide and Checklist. On page 4 of that, there is a outline that says, how will this loan be forgiven? And they go through the process fairly clearly in terms of the lender will look at what was spent during that 8-week period on payroll costs, interest, rent, utilities. And then they show 2 different formulas for how might that forgiveness amount be reduced based on any potential reduction in headcount or in wages. I don't want to read through that, but to me, that has been one of the best explanatory pieces on how the forgiveness works, what you can look at for eligible costs to count to that total, as well as how it may be adjusted for any reductions you have had to take in terms of staff and or compensation levels. For PPP, if someone is laid off, does the same person need to be rehired before 6/30, or just that position have to be filled? That is a great question. I am guessing it is just the position because they are not looking at specific names. They are looking at full-time equivalent or FTE headcount numbers. So I think if you send, support for here's my payroll, here are the calculations, and here's the calculation for my employee headcount based on FTEs, that's not going to be a specific person-to-person calculation. Crystal ball question. Does the Community Foundation have any preliminary general advice for all of us on adjusting old bills income projections? Thanks, Pauline, for that one. I think that will vary dramatically from organization to organization. And by that, I mean, for example, if you were 120 due and you were having to do a huge, major program fundraising campaign right now for response, it will be potentially, although I hope not necessarily the case because I don't want to see it happen, that their donors may then find it harder to give to their operating during old bills because they will have had a heavy ask and a heavy lift right now. If you are an organization who has essentially closed, you may be in a different position in terms of going back to your donors and asking for critical operating support to ensure your sustainability. So I think it will vary from organization to organization depending on what kind of fundraising they've had to do right now for immediate service and direct programming related to COVID-19 versus other organizations that are in a different position. I think in terms of the match, I wish I had a crystal ball. We do know there will be some co-challengers who have already communicated that they are not going to be in a position to necessarily make the same gifts this year. We have others who have said, we are in, we're committed, let us know what you need. We've had others who have said, use it where you need it most. If you wind up needing it for COVID response, please do that now. And if you are able to adequately fundraise for that and make those operating grants as large as possible at a time when our nonprofits will critically need unrestricted operating support, because I think that will be a time when many of us in the nonprofit sector are really going to begin to struggle with perhaps our reserves are running out and our operating is not the same. And if the longer this draws out, the more likely that is. I also know, looking back on 2008, 2009, that was the one year that our match pool did indeed drop, was when the stock market took a huge hit. So I would be remiss if I didn't say that's not a potential outcome again this year with a significant decline in the stock market, that we'll see slightly lower co-challenger giving. What I can also reassure everybody is we, the Community Foundation, are going to be doing our absolute darndest and working as hard as we possibly can to maximize that pool to ensure that we can provide as material significant a matching grant as we possibly can. So no crystal ball answer for you, but just a brief off the cuff that those are my thoughts. Don't hold me to them in October unless we've like really knocked it out of the ballpark. Go from there. All right, another question. My understanding now that I've submitted a PPP loan is that we are no longer eligible for EIDL. And to be totally transparent, I'm trying to maximize the amounts. I think it's hard to say. Clearly the guidance that I've read is that you can't be applying for both an EIDL and for the PPP for the same use. And I think the lenders are asking, specifically when you're doing your application, do you already have another SBA loan in place or application in place for this use? I think you can make an argument that they are being used for different things. The PPP loan is clearly more restrictive in the eligible expenses versus an EIDL. One is forgiven, one is not. So you could get the PPP, have it forgiven, and still have an EIDL loan for working capital that are using. I think whether or not you go for both, or put all your eggs in one basket, if you will, and apply for, if you're going to do that, I would say apply for the PPP because it can be forgiven. I think it really depends on how large your operating expenses are. Do you have the capacity to clearly say, the PPP, I have so much in the way of other costs above and beyond my payroll that it justifies applying for an EIDL loan. I think many of us, unless we are organizations with larger facilities, our main cost is payroll. And so coming up with a significant amount that's material enough for an EIDL loan may not make it worthwhile. But if you have significant facilities and other costs above and beyond payroll, then it might make sense, would be my initial take on that. And say, am I reading this right, that you have to be an EIDL applicant in order to access the 10K emergency grant? You do have to apply for the 10K emergency grant. And it is part of the EIDL loan application, is my understanding. Like, to get the grant, you have to be applying for an EIDL loan, even if all you apply for is $10,000 in the form of an emergency grant. But you can also do a larger loan amount and ask for $10,000 of it to be paid out in 3 days as an emergency grant. But my understanding is, yes, you actually have to be applying for the EIDL loan and processing that online application through the SBA. The EIDL and the PPP loans are not both forgivable. Only the PPP loan is forgivable. The EIDL loan is another option, but it is not forgivable. The only part of the EIDL that is quote unquote forgiven is that $10,000 emergency advance. And that is just essentially an automatic advance. It's not even forgiven. My understanding is when you put in that application and you say that's what you are looking for, when you are approved, you receive that, and it's a grant. It is not a loan or a forgivable loan. The $10,000 is an emergency grant that is available through the EIDL program. The EIDL loans themselves are not forgivable. So I think there have been a few questions on that. So the $10,000, and again, I would refer you to the US Chamber of Commerce guide on the EIDL loans. The EIDL is a loan and emergency grant program through the same application through the SBA. The $10,000 emergency grant is just that. It is actually an emergency grant. It is not a loan, and there's no forgiveness or forgiveness formula or parameters associated with it. The EIDL loan, if you apply and receive a loan in addition to the $10,000 emergency grant, that is a loan with its own payment terms, and it is not forgivable. The PPP loans are a separate program. Those are the ones that go through the local banks versus directly through the SBA. And the PPP loans can be forgiven if you have the correct amount of eligible expenses to apply towards that forgiveness, with an adjustment for a potential adjustment if there's been any reduction in headcount or total compensation. So Chamber of Commerce link doesn't seem to work. I can't speak to that, but the handout itself is actually included in the workshop materials that Annie distributed. So if for whatever reason the link is not working and you're struggling to find that that guide via the link, I would encourage you to actually just look through the PDF copy of workshop handout materials that Annie sent, because I specifically included that in that guide, both to the PPP and to the EIDL in the webinar materials. Okay, let's say we apply in total for $15,000 and we're waiting on our bank to apply for PPP. Should I apply for the $10,000 emergency grant through the EIDL now, and then when PPP opens up, apply for an additional $5,000? My biggest concern is the bank money will run out. Fair enough. Yeah, I think that is a concern I'm hearing, is does it make sense to apply for that emergency grant now, because you can actually get that application in right now through the SBA. I think in terms of how you play those numbers, rather than saying I will apply $10,000 for the emergency grant and $5,000 for the PPP, I would say apply for $15,000 through the PPP. If you get the PPP and the emergency grant, just know that your PPP loan forgiveness will be reduced by the $10,000 you've already received through the emergency grant. I think if you only apply for $5,000 and that $5,000 is forgiven, you're not going, they're going to say it was reduced. So I think I would just ask for the higher amount in the PPP and know your forgiveness will be reduced accordingly for any emergency grant funds you may have already received. Are there other questions? Okay. Oh, wait, let's see. Can you just send back any unused funds from the PPP to avoid interest payments? Yes, there is no prepayment penalty. So if you get the loan and you're good to go because things turn around quickly or other revenue sources come to fruition, you can simply repay that loan whenever with no prepayment penalty to avoid further interest expense. All right, I think you guys are slowing down. You're all eyeing the sunshine outside and the fact that it's like 50 degrees and your brains are fried with federal loan regulations. So I don't have anything further to add. I think, quite honestly, all of you guys know where to find me if you have further questions. There is lots of information in the webinar materials that I pulled together that Annie distributed. There are plenty of resources on the internet. I tried to kind of pare it down to a couple of user-friendly ones that I personally found to be the clearest and the most user-friendly in terms of explaining the parameters and rules and regulations and options available. So please feel free to look through those materials, but if you have questions, hit me up, or if you want to share opportunities with me so that I'm aware of them, like what banks are doing what based on your experience, would love to hear that. And I think I would just close by encouraging all of you to tune in tomorrow to the third option in this series with Gary Trauner from Silicon Couloir. He's going to be covering strategic planning and refocusing on your organization's core and mission and competencies and leadership and managing staff remotely, and potentially expand on some of what we've covered here, but also just augment your capacity and resources and ideas in a whole nother direction that I didn't touch on. So I know he will be a wonderful resource as well, and encourage you to participate in that if you are able to. That's all I've got. Thank you all so much for participating today.